The gentleman from Texas, Mr. Green.
Thank you, Mr. Chairman, and I thank you again, Madam Chair. Madam Chair, it's my belief that prior to 2008, AIG was an insurance company. Is that a fair statement?
Yes.
And as an insurance company, who knew that AIG was a part of the glue that was holding the world together? AIG, an insurance company, by definition, under some standards, might not be declared a SIFI, but by virtue of what AIG was doing, AIG was clearly a SIFI in 2008. Would you please elaborate for just a moment on why you look to see what businesses are doing so as to determine whether or not they are a SIFI?
So I think you've pinpointed it. You just answered the question, which is that firms may engage in activities that capital market activities, whether it's derivatives activities or involvement in securities lending or wholesale financing, that would create a situation where their material distress would create systemic consequences for the U.S. economy. And AIG is a case in point. And that's precisely the analysis that the FSOC is doing of individual companies when it decides whether or not to designate them.
Let's talk about income inequality. Why is it important for us to pay some attention to the chasm that's developing between the very, very rich and those who have been not so fortunate in life? Why is this important, Madam Chair?
Well, I think all of us treasure living in an economy where we feel that people who work hard and play by the rules can get ahead and can see themselves succeed and advance. And we've been accustomed to that in this country generation after generation. And when we, over the last 25 or 30 years, realize that income inequality is increasing and it's been an inexorable rise, that's really, I think, a concern about the quality of life and the ability to get ahead and to see improvements.
And for the edification of people in general, would you give a working definition or a simple definition, as simple as you can, of income inequality?
Well, there are many different measures of income inequality, but we can look at one common ratio would be to look at the ratio of income earned at the 90th percentile of the income distribution to that at the 10th, or there are measures called Gini coefficients, other measures of income inequality. Regardless of what measure you look at, I believe what you see is rising inequality since the late 80s.
Well, let's simplify what you've said to a certain extent. I greatly appreciate it. But would we look at, for example, what a CEO, the average CEO, was making compared to the worker, say, in 1950, and then compare that to what the CEO is making today, maybe at 1950, let's just use an arbitrary number, say about 50 times what the worker was making, and now the CEO makes 500 times maybe what the worker was making. Is that kind of comparison, is that done?
Well, that's another kind of comparison that one can look at, and I don't know the numbers there exactly, but they're pretty dramatic.
Yeah, they are dramatic, and I use those numbers to illustrate just how dramatic things can be, not to contend that they are the exact numbers. But that's some of what we're experiencing, this unusual expansion of the chasm between workers and the CEOs. That's just one aspect of it. Let's move now to meetings. How many meetings have you and your staff persons attended over the last year?
I'm sorry, how many meetings?
Yes, ma'am.
Have I attended?
Yes, ma'am, and your staff people. We were talking about meetings.
With members of Congress?
Yes, ma'am.
I'm not sure.
No way to know.
Many meetings.
How many meetings have you attended regarding Congress and congressional business, and leaving your staff out of it now?
I've had many individual meetings with members of Congress. I don't have an exact count.
Do you decline meetings?
Testimony,
do you decline meetings with members of Congress? When members ask for meetings, do you decline them?
No, I have not declined a meeting with a member of Congress.
Finally, I'd like to get a written response from you on how the chairperson of the president of a Federal Reserve bank is appointed, and how the public can have access to that process and input into that process.
So Federal Reserve bank presidents are appointed by their boards of directors. The banking members, the so-called Class A directors, cannot participate in that process. So it's the directors that represent the public interest and not banks that run that process. And they make recommendations after thorough national searches, and the Board of Governors must approve those appointments.
The time of the gentleman has expired.